Good morning. I'm Gord Long with the Financial Repression Authority. As part of our series on financial repression, I have Dr. Marc Faber joining once again, this time from Thailand. Welcome back, Marc.
Thank you.
It's a pleasure to have you back. I always enjoy the discussions. Always too much to talk about, so I'm going to jump right in on this. But first of all, I should, for some of our listeners, could you just give them a brief understanding of your report, the gloom, boom, and doom report? I apologize.
The gloom, boom, and doom.
Right.
And basically, I have two reports. One is a printed report that goes out by mail that is more suited for, say, high net worth individuals and institutions. And I have, of course, the views are the same. A website report that can be obtained at www.gloomboomdoom.com. That is more of a timely report.
Marc, I want to, as I said, jump right in here. The Bank of Japan just mentioned or just announced, I think shocked a lot of people 10 days ago, a negative. Kuroda certainly reversed his opinion, it seemed, from what he was saying at Davos. But anyway, negative interest rates. What does that mean in Japan, and what do you think it means around the world? And is this going to be something that's going to be carried to the United States?
Well, basically, it's an experiment. A few mad professors that occupy senior positions in central banks, because over the last 5,000 years of recorded human history since the times of Babylon, we never had interest rates as low as they are now. And as you know, there is some time value to money. In other words, if I give you the option, you can have today $10,000 or in 3 years $10,000. What would you take? Today, the $10,000, or wait for 3 years for $10,000?
Exactly.
So the point is simply this. This time value of money is the natural state, the market way of pricing today's money and future money. The greater the uncertainty the future money is, the higher the rate of interest will be. But what central banks are doing at the present is incomprehensible to me, unless it means an expropriation of money of decent people who actually saved some money. So let's say you worked all your life and you didn't trust the brokerage community, which is quite understandable, and you just accumulated some savings, and between 1970 and say year 2000, you get, I don't know, between 5% interest up to 12-15% interest on money. And now you deposit the money with a bank, and for the privilege of depositing the money with the bank, you deposit, say, $100,000, and in a year's time, you only get back 99,000 back. So basically, it's a tax. And the central banks, in their madness, they believe that this will now stimulate economic growth. What it will do, it will force people to become insecure because they don't know, what to do with the money anymore. In other words, they don't get any interest on their deposits. So they may actually withdraw money. Or if I put to you the following question, let's say you get 6% interest on your money, and suddenly interest rates are zero or less than zero. In other words, you're penalized for having money. Does that make you save more or does that make you spend more? Say, if you're a pensioner and you had $1 million in your savings account and you got before five, 6,000, $50,000, $60,000 interest a year, now you get nothing. You think you're going to spend more or you're going to be insecure?
Great. I think, Mark, I think we already have that situation now without negative rates. I see this with pensioners who had planned on 6% getting almost nothing, forced to save at a rate they had never expected to before by cutting back, and also their children and the grandchildren have problems with student loans and needing money to support them that they hadn't planned on. So it's already here, ever mind negative rates.
Listen, I will never understand one thing in my life. We have democracies, and somewhere, somehow, the system has given so much power to a bunch of well understood, unelected academics, most of them who have never worked in the private sector for a day. They were at universities, the Federal Reserve, the Bank of Japan, the ECB are all like-minded people. There is no strong dissent. They all believe money printing boosts economic activity and tight money is negative. And I tell you, I think they will bankrupt the world. Now, what do you do in this environment? We don't know exactly the sequence, how badly it will end. But one thing is interesting. If you look at, say, the financial crisis 2007, 2008, which sector got the most money, the bailout money? Which sector then got subsidized the most with artificially low interest rates? The banks and the fund managers. And then you look at the performance of their stocks. It's a disaster. It's a disaster. And then these people who have stock prices that are, you look at, say, Carlyle, he's a typical fund manager, sponsored essentially by the elite. The stock is down now 70% from its high. These are the people that got the most bailout money. So if you really think about it, the bailout money and money printing doesn't help at all. It has made matters worse for the average American. And I understand that Americans kind of now follow and they like Bernie Sanders because he is expressing the view of ordinary Americans that the Wall Street guys and the banking syndicates have essentially cheated the American people. And in Europe, it's the same story. In Europe, it's the same story. Strictly speaking, Deutsche Bank is probably bankrupt. But Uncle Draghi and Auntie Janet Yellen, they will give them money so they can survive even longer and cause even more damage to the global economy.
Back to just the negative interest rates with Japan. This is EU has been the ECB's been doing this for 2 years. We've got it in Switzerland, and we saw the fallout that happened there with the electorate when they went to negative rates. We have it in Denmark. I believe we also have it in Sweden. It hasn't worked there, has it? I mean, we have some practical examples.
In every instance where they have negative interest rates, exactly the opposite of the objective occurred. Savings rates went up. It didn't stimulate the economy.
So, Mark, with that kind of proof, what is it they're thinking of to possibly do this? Is it just that they feel they have no other option? and they see a crisis or a problem, or is it just plain stupidity? Or a combination of all the above?
Well, just watch the movie One Flew Over the Cuckoo's Nest. Who are the bad people? The inmates or the doctors? You tell me.
Well,
This is exactly the same. You know, this view of central banks to essentially influence or distort the free market mechanism and the capitalistic system is a view of the paternalist, that some people, they think they know better, that we, you and I, are so stupid. They need guidance from some professors, from some academics. This is the original thought, that they can steer the economy like you would drive a car, forward, backwards, sideways, and so forth. Unfortunately, the economy is not a car. And even if you drive your car, you can still have an accident.
Mark, what's your views on the Federal Reserve recently having increased interest rates or rates against what clearly is a slowing? I look around and I think the U.S. is in a recession. Personally, I see globally the slowdown is staggering. Could you make some sense out of that move for me?
I mean, yes, I can make some sense. First of all, Miss Yellen, she was the president of the San Francisco Federal Reserve between, I think, 2005 and 2008, something like that. And the San Francisco Federal Reserve is in charge of California, Arizona, Nevada, and I think another state. But in any event, in her district, we had the biggest real estate bubbles ever. And you think Miss Yellen could ever see a bubble? No. Miss Yellen will never see anything. And then she became Fed chairman and slashed interest rates after Mr. Bernanke bailed out the system. And they kept interest rates at zero starting December 2008. So we're now January 2006. So 8 years, we had basically zero interest rates. And then she increases it by 0.25%. Hey, 0.25% is meaningless. Number two, she should have increased rates when actually there was a strong recovery. In 2010, 2011, a recovery actually got underway. But no, she waited. And she waited, as you said, right until the world is entering a very steep recession. She will go down and she will have front portrait in the Museum of Central Bank Failures. She will have a huge bust and the portrait. Janet Yellen increasing rates right at the time of the beginning of a recession.
With this,
I mean, it's hard to believe, but I mean, as a working man, as anyone who goes as a business or works for a salary, it's hard to believe that the world has handed so much power over the price of interest to a bunch of ignorant, arrogant people.
this can only be described as monetary malpractice, for lack of better words. But where does it lead, Mark? Because clearly we could see a global deleveraging because the Fed can fix liquidity, but it can't fix insolvency. And to me, we have an insolvency problem with the debt level.
Yes, I have a friend in America. Since you ask where will it lead, he has built a perfect replica of a guillotine and he intends to send the Fed members there. Systemically, I think they have allowed essentially the debt level to expand. In particular, they have allowed government credit to expand as a percent of the economy. And I think eventually there are reasons to believe that actually central banks will go bust. Maybe because they can keep on printing money, not officially. But you have to understand, when you try to suppress individual risks in a system, eventually you end up with a systemic risk. And that is what we will have. We'll have a huge crisis eventually. And I can only say investors don't know exactly how it will be played out. Will it be a deflationary collapse? Will it be a hyperinflation? Will it be expropriation? But what I see already today is that people like Bernie Sanders, they're not blaming the Fed. They're blaming Wall Street. In other words, they're blaming rich people for the hardship of ordinary people. When you throw money at me, I'd be stupid not to take it. You understand? Essentially, the Fed threw money at Wall Street, and who is on Wall Street, you know very well. They are natural that they took the money and they kept it for themselves. Yes, there is a so-called trickle-down effect. They go to restaurants in New York, and so they give to the waiter a tip. But in the meantime, because of the asset inflation, the waiter, he can't afford to live in Manhattan anymore. He has to go and live somewhere else. So the trickle-down effect has been almost insignificant. And affordability is a big issue. If you go to San Francisco, Newport Beach, Southern California, anything south of Los Angeles and Los Angeles, Seattle, New York, Boston, the typical family, the average or median household, they spend approximately 50% of their income on rents. Thank you very much, the Federal Reserve, geniuses.
And then oh no, it very much so, and I see that every day, right down to rental properties. For those who can't even imagine owning a home, they're having troubles even paying rent that is going through the roof in the United States. But if I could switch gears a little bit, Mark, your view, the geopolitical issues, risks that we see. There's been a big focus on China. There's been a big focus on commodities and oil. Now we're starting to see an additional concerns with the European banks, the concerns with a U.S. recession possibility being added to this geopolitical risk. What's your views on that, and what one worries you the most?
Well, basically, we have in American economics, we have the interventionists. These are the so-called neo-Keynesian, like Krugman, and then the monetarists, like the Federal Reserve. They believe they can move things around. And then we have the neocons in America. They think understand anything about foreign policy, and they go around the world like Hillary Clinton when she was state secretary and talks about nation building. What a nonsense that is. Everything the US touched in the Middle East and Central Asia, whether it's Afghanistan, Iraq, Syria, Libya, Egypt, turned into a complete disaster. Disaster. And then the neocons had this brilliant idea to start making trouble in Ukraine, not understanding that anything east of the Dnieper is actually Russian territory, and that historically, until the early 20th century, Ukraine was part of Russia, and that for Russia, Crimea, East Ukraine is of strategic importance. The way you say, Florida or California is of strategic importance for the US or Hawaii. That they did not understand. And so they got the reaction by Putin. And I can tell you, the Russians will never ever give up Crimea. Never. They will die for it because it's a warm water port. And they need it to have the access to the Mediterranean. They don't have the Crimea. They are essentially at the mercy. They're encircled by America. And this theory was essentially the containment theory developed by Nikolaus Spykman after the Second World War, that you encircle the Soviet Union in the east and in the south in Central Asia and in the west in Eastern Europe. And that has backfired very badly. And I mean, the Europeans are equally incompetent. That Merkel is kind of the lackey or just the butler of the US and follows them, not understanding she's actually hurting the business interests of Germany, and that Russia and Germany were actually historically seen culturally very close and politically, I might add. So the interventions are very, very poorly thought out. And then the Americans also had this, also Hillary Clinton, I may add, this brilliant idea of announcing the pivot to Asia. Now you put yourself into the position of the Chinese. The Chinese now are the second largest economy in the world. It's a country with 1.3 billion people. They're not backwards anymore. They're highly advanced, especially in defense technology. A pivot to Asia by the US is in their perspective. I'm not saying justified or not. This is not my judgment. I'm just saying in their perspective, it's an aggression against China to encircle them and a threat to the sovereignty of China and to the security of China. Because you see, China, unlike the US has access to resources domestically. They have access to oil in Canada, Mexico, in Latin America, in the Middle East, the North Sea, and they have access to the sea, the Pacific Ocean and the Atlantic Ocean. China is surrounded by American military bases, and the US has aircraft carriers. China has just one. So they feel threatened, and that has created another set of geopolitical tensions. I mean, I think, quite frankly, the threat of military confrontation, given the weakness in the economy, has increased.
How much of the U.S. policies in specifically the Middle East, but a lot of these countries, is driven out of a fear of the collapse of the petrodollar, and therefore the amount of U.S. dollars coming home and to roost that won't be needed?
I mean, it's difficult to tell what exactly people think, because, say, you just started the interview by mentioning the negative interest rates in Japan. The idea of Mr. Kuroda, by the way, he's also a career banker who made his career with just about the worst and most corrupt financial institution, the Asian Development Bank. And he became essentially the head of the Bank of Japan, BOJ. His intention was actually to weaken the yen. Not that the weak currency helps anyone, but by slashing interest rates or setting them below zero, and it's remarkable now the 10 years Japanese government bond is yielding less than zero, you understand? So if you buy a 10 years Japanese bond, you're bound to lose money unless the yen appreciates
Right. Exactly.
meaningfully. But his idea was you go below zero, and then the yen weakens. What happened is the yen strengthened. And that, I think, is a good sign in the sense that the market is no longer trusting central banks. You understand?
Mm-hmm.
The central banks basically, under Mr. Greenspan, they enjoyed a lot of prestige. And Greenspan, rightly or wrongly, he enjoyed a lot of prestige. He also made mistake. He deliberately created the Nasdaq bubble, and he bailed out LTCM, which was, from a market economist point of view, a big mistake because he gave a signal to Wall Street, just leverage up, we'll bail you out. But in general, he was a central banker with a lot of authority. After him, Bernanke, Yellen, they're complete puppets. I don't believe that actually they take the decisions. They're told by someone what they should do.
I think you're not alone in believing that, Mark, at all. More and more and more sensing that. In your area in Asia, whether Vietnam, Cambodia, Myanmar, are there good investment opportunities there now? Increasing? Are there risks? Increasing? Are there
Yes,
risks?
but you understand, we have in Asia, say you look at Asia over the last 50 years or so, we had first strong growth in Japan, and growth shifted more to Taiwan, South Korea, Hong Kong, Singapore, and then after 1985, 1990 to China, and now more to India. And we have in Indochina, which is basically in the east facing China, Vietnam, and then northwest, we have Laos, southwest, Cambodia, and then first Thailand, Myanmar, and in the north, Yunnan province of China, and the south, Malaysia, Singapore. That region is a boom town. Mm-hmm. Not Thailand, but say Cambodia, exports are rising at around 20% per annum. Vietnam has huge inflow of foreign direct investments, partly for economic reasons. You see, the Taiwanese, Koreans, Japanese, they can invest in Vietnam and produce goods there much cheaper than in their own country. So there's a lot of investments coming from Southeast Asia. And there is also a lot of investments coming from China. And the reason all these investments are actually going there is that the West, under the US, they are afraid of China gaining too much influence in that. So they invest money there and try to kind of displace the Chinese. It's not going to succeed because the Chinese, to go to, say, Cambodia, they tell the government we're going to build a road or a bridge, and in 6 months the bridge is built. Whereas the Western world, they send a team of useless characters that are at the World Bank or the ADB. And so first, and have tea in these hotels and enjoy the scenery. And then they say they come back in 3 months' time to make a further analysis. Then they send another team. And 5 years later, nothing has been done. But the teams have stayed in these hotels for ages and piled up huge expenses, which essentially the taxpayer pays, and nothing has been built. Whereas the Chinese in that time has built roads and bridges and tunnels. This is the difference. But the money is pouring into this area like Cambodia, Laos, Myanmar, and these are boom towns, real boom towns. If you go to Cambodia, it's a boom town. But it's not so easy for, say, an investor sitting in the US making money out of Cambodia because there's only one listed company. And he would have to make direct investments. And direct investments, there is a huge execution risk. I mean, I'm the chairman of a company we invested in Vietnam in real estate. And okay, we started at the time when Vietnam was taking off before 2005. And then there was a huge crash. And the company has done really well, but the investors haven't really made money, except the ones that bought actually properties directly in our hotel in Nam Hai, in Hoi An. These people made money, but the people that invested in the funds, they haven't really made money. Similarly, I'm the chairman of a Cambodia fund, and the investors haven't made any money. It could have been worse. But just saying, optically, you can say, oh, this country's booming, yes. But unless you go there yourself and you work your so-called ass off, it's going to be difficult to make money just by giving money to someone to do it for you.
Mark, last question here. We have to wrap. What advice would you give investors from your perspective, especially with some of the worrying comments we've discussed here?
Well, I don't know. I mean, I can tell you, in my view, it will not end well. This artificially low and market distorting interest rate structure, it will end very badly. We don't know exactly how it will end. And so my advice to everybody, and I've written about this 100 times, but nobody listens, of course, is to have a diversified portfolio. You have to have some equities, and you have to have some bonds, and you have to have some real estate and some precious metals. Now, some people, they said, I think it was the RBS, Royal Bank of Scotland, sell everything. I think they said 2 weeks ago. The problem with the notion of sell everything, okay, you have $1 million or $10 million or $100 million. What do you do with it? You understand? You're going to deposit it with the bank. The bank goes bankrupt. You understand? Sell everything. Isn't it? Conceptually, it may be the right idea, but in practice, it is very dangerous to have all your money with one bank.
Now you may say, well, it may be more risky.
Yes, I put it with 10 different banks. But if one bank goes bust, then maybe all the others also go bust. You understand? So I think people that own assets, we had a colossal asset inflation from the early 1980s for bonds since 1981, when interest rates on long bonds were over 15%, for stocks since August 82, when the Dow was below 800, and real estate went up, and collectibles went up, vintage cars went up, and paintings went up, and then. And now I believe we will get a period of asset deflation, where asset prices go down, and so we'll all lose some money. The question is, how do we lose the least money? And so people this year, if they were 100% in stocks, they lost already a lot of money actually over the last 12 months, because the typical stock is down more than 25%, the average stock on the New York Stock Exchange. But people that had some treasuries and some gold, they've done okay. Because this year, treasuries are up strongly. And it's interesting, all the Wall Street strategists for the last 3 years have said that bonds are a horrible investment. But these are the people that work for the financial institutions whose stocks are down 80%. But these are the people that are always on CNBC and on Bloomberg. Would you give your money for management to someone whose company stock is down 80%? You would ask yourself, why would I give money to people that can't even look after their own value?
I look at the 10-year Treasury trading around 1.78, and I can remember just the other day it was like 2.4, 2.5, and Oh, so I apologize. But they were on CNBC saying it was going to 3%, and it wasn't the place to be. So, and,
Yes,
and
never listen to CNBC and these clowns.
well, with that, Mark, I think that was good advice, sage advice. We'll break from here. We have to have you back. Thank you very much for taking the
Thank you,
time.
Mark.
Could you just mention once more where our listeners could follow your work?
Gloomboomdoom.com.
Got it. We're off. Talk to you again.
Bye bye.
Bye bye.